And Dan Greenhaus of Solus is here with us at Post 9. All right, so you heard from the Treasury Secretary today. The market's going for 10 in a row. We might just get it, too. I mean, we're well off of where we were earlier today. We're already back 17.5% on the S&P from the lows. Where are we going?
Listen, now that we're back where we are, I think, and as viewers probably know, I've been somewhat optimistic, very optimistic relative to the consensus. But now that we are back where I thought we should have been, which is around Liberation Day levels, we can reassess the environment. And I think from here, it's a little more complicated. You do have tariffs coming down the pike. You had the president obviously tweeting about tariffs on things like Hollywood movies that are produced overseas, et cetera, et cetera. So that story is not over with. I just don't think it's going to be as bad as a lot of people anticipated. Plus, you've got the 200-day, on a more technical basis, you've got the 200-day moving average, about 1.5% above where we are. And I think there's going to be a lot of hesitancy among those of us that look at those sorts of levels until you consistently or confidently break through.
We're far from where we were, obviously, not just from a market standpoint, but feels like from a sentiment standpoint, too. I want you to listen to what Brad Gerstner of Altimeter told me earlier on halftime. He, too, joining us from Milken today about the level of risk that he is willing to take right now.
At certain times, there are these macro events that mean you have to reduce or increase your units of risk. So think of it as a volume knob. And in 23 and 24, I had 9 units of risk on. So our volume was turned way up. At the start of this year, we turned that down to 1 unit of risk, 1 out of 10. And today we're back up to about 6 or 7 on that volume knob.
That's a pretty interesting perspective. Beginning of the year, all the way down, turn the volume all the way down because it's too noisy. And now 6 or 7. That sounds like a pretty decent environment that we are in now. Yeah,
he's talking about leverage. And I think for those of us on the asset management side of things, that's how you're supposed to think about the world. You can take more risk when you flop aces, so to speak, and when you flop a 2-7 offsuit, then maybe you want to dial it down a little bit. And I think to Brad's point, right about now, I think it's fair to say you're more comfortable with the environment. You know that the president isn't as draconian as perhaps the original headlines suggested to some people. Obviously, you're not going back to zero. Everyone agrees that there's probably a 10% across the board baseline, but you know it's not going to be as bad as you thought. Plus, in conjunction with that, you've got Q1 earnings season, which went really, really well. Basically double expectations on the EPS side of things, and corporate commentary was not phenomenal, but was quite good.
It was far from phenomenal.
It was far from phenomenal. That's right.
Let's be honest. It just wasn't nearly as bad as people came in thinking it would be.
I'll disagree,
but you'll disagree?
I'll disagree. I mean, listen, again, you just had MasterCard. I've said this 100 times that I think the card companies are the premier conference calls you want to listen to and follow. MasterCard just reported and basically said the same thing that Visa, Capital One, American Express said, which is sure there's some under the headline behavioral changes, maybe a little bit more of this, a little bit less of that, but they've seen no real change in consumer behavior right now. And I think you have some of the best reporting names, GE Vernova, Honeywell had an excellent report, Trane Technologies, Pentair, a host of industrial companies had pretty good things to say. We talked about tariffs being manageable, the environment being stable, outlook being positive. Obviously, that can be thrown, a wrench can be thrown in the works in 1 or 2 months, let's say. But I disagree. I think the first quarter was solid.
Okay, solid's better than, I mean,
I stopped myself from saying phenomenal.
Okay, good. I mean, you self-corrected. I didn't even have to do it. There still is a lot of uncertainty. And to that end, Adam Parker suggests that they are way more negative now than they were just 2 weeks ago. Why? Because, as he says, and I quote, "There's no doubt in our minds that conditions are meaningfully worse and more uncertain now than they were at the beginning of the year." You don't think that's true?
Well, things are certainly, the environment is more uncertain today than the beginning of the year. I absolutely concede that point. And that's why, while I've spent many weeks on this set with a number of other people taking the more optimistic view of things.
You did.
Now that we're back to 56.71 as of this moment, I think you have to temper your enthusiasm a little bit and say, okay, well, what is the catalyst to take me not just above the 200-day moving average, which is an important level, but back up towards the highs or even beyond? And I think with that level of uncertainty right now, that idea that you would go back to the highs, at least in the short term here, is probably challenged.
Well, don't you think that as the market's recovered and the multiple has grown higher once again in a lower growth environment, That's a bit of an issue. Earnings weren't fabulous. They weren't horrific, but they're still slowing.
Sure. But I also don't think the focus on valuations right now, I think, is totally misguided. And by right now, I mean 2 years. This is not a valuation-driven market. First of all, you have the discrepancy or the divergence between the valuation that we place on the Mag 7 type stocks, NVIDIA, Broadcom in general. Tech is the largest weighting with comm services. Obviously, you're talking about a humongous percentage portion of the S&P 500. That's going to just mathematically pull up the index valuation, but deservedly so in many cases. They're growing at a more rapid pace. But I would also add that a lot of what's going on in markets right now is about money flows. It's about allocation. It's not really about valuation. The market is compelling. I need to get involved. It's cheap. The margin of safety, et cetera. I don't think that's the issue right now. I think it is more about flows than anything else.
You worry about, in any way, the so-called American exceptionalism trade, which has been highly debated over the last month? Treasury Secretary Bessent obviously defending it. Why wouldn't he? That's part of his job, is to defend this great country, and why money should be flowing to the safest and deepest markets on the globe.
And we are still the safest and deepest markets. We are still the world leader economically, politically, certainly militarily. To put numbers on it, at the basis level, the U.S. consumer spends $20 trillion, $6.5 trillion or so of that is on goods. The world wants access to that. The president is correct about that idea that while how he's going about it and the tone and all that we can debate, conceptually, you do want access to that market. And in that sense, the U.S. exceptionalism remains unrivaled.